Hello, welcome to Gross Income Problem 2. In this video, we'll continue discussing gross income. Cherry organized a wholly owned corporation and contributed $200,000 to the capital of the enterprise for 2,000 shares of common stock. The par value was $100 per share of that common stock. Now, a wholly owned corporation refers to a corporation that is wholly owned by one owner, here Cherry. Again, the par value is $100 per share, and that's simply just the value printed on the actual stock certificate. And there's 2,000 shares. So the 2,000 shares times $100 par value equals the $200,000 contributed to the corporation. During the first year, the corporation accumulated net earnings of $100,000, but no distributions were made to Cherry. Now, it's important to understand that if you've never dealt with corporations, corporations are separate legal entities, and they are separate from the owner, Cherry, under the actual law. Now, we're trying to examine if there's gross income. And remember that we go through our 5 questions, and of the 5 questions, when we're looking at gross income, we have to look at what amount of gross income, when there is gross income, and who has gross income. And who has gross income. So, in terms of looking at what amount, we have to specifically focus on Glenshaw Glass, the Supreme Court case Glenshaw Glass, which says that gross income is defined as an accession to wealth, an undeniable accession to wealth that is clearly realized, in which the taxpayer has complete dominion and control. So there's 3 elements. The first item is accession to wealth, which simply means your net worth has increased. The taxpayer's net worth has increased. The second is there must be a realization event. We'll talk more about that, a realization event. And again, that's mainly administrative concern element. And third is there must be complete dominion and control, which sometimes I like to abbreviate D&C, but that's dominion and control. Now, in the previous videos, we talked about the distinction where gross income for tax purposes is more, it has a baseline of economic income, but it does have some elements of financial income, mainly from, again, administrative concern standpoint, and that's why we apply that. So here, we look at the net worth of Cherry. Let's focus on Cherry. So the only taxpayer we have here that we're going to examine is Cherry. So we're looking at Cherry. Cherry, before Cherry owned the corporation, Cherry had this $200,000 of cash. So that was before. So before, Cherry has $200,000 of cash. After Cherry organizes corporation, Cherry has stock worth $200,000. So if we're looking at when, immediately after this transfer of cash for stock, when Cherry receives that stock, does Cherry have gross income? And looking at our definition of gross income, which under Section 61 of the Internal Revenue Code, it just provides that it's just broadly defined for any source derived. However, again, we have to look at the Glenshaw Glass definition of net worth increasing. There is no net worth increasing. The net worth is assets minus liabilities equals owner's equity. So that's derived from the accounting equation, assets equal liability plus owner's equity. And if we isolate owner's equity, which gives us our net worth for a business, or here it would be stockholders' equity, then we can just focus on the assets and the liabilities part. So if we're looking specifically at the time it was organized, have our assets gone up? No. 200,000 equals 200,000, so they stay equal. What about our liabilities? Because you can have net worth if liabilities go down. Because if assets go up, owner's equity goes up. If liabilities go down, since it's a negative, owner's equity goes up as well. But if you have the opposite, that's not the case. Owner's equity goes down. But again, net worth or accession to wealth is when net worth increases. So have liabilities gone down here? No. They also remain the same. So therefore, at the time of the the contribution for the stock, there is no gross income. And again, that's because the net worth has not changed. So that is, when you're looking at when, at the time of contribution. Again, an exchange, really, well, not exchange, but getting the stock. So another date that we need to look at here, another time to consider, is what about during the first year, the corporation accumulated net earnings of $100,000. All right. So once we do the contribution, at the beginning of the year, Cherry has stock worth $200,000, right? That's where we saw that. That comes over here. $200,000 value of the stock. After, at the end of the year, after the corporation now has accumulated net earnings of $100,000, what happens? The net earnings, they increase the value of the company. Now, the company is worth $300,000, and because Cherry, it's a wholly owned corporation, which means Cherry is the only owner, Cherry now has stock worth $300,000. So when we do our assets and liabilities, assets have gone up because $200,000 to $300,000 assets have gone up. So that means our net worth, item number 1, is met. What about our realization component? Realization component. So what did we have before? We had stock. Let's assume that, well, it's 2,000 shares of stock. After, we have more valuable stock, but we still have 2,000 shares. So the question when it comes to realization is there a legally severable aspect that has happened here? So what I'm saying is, look at this. Before, or at the beginning of the year, when the corporation, when Cherry got the stock, there's 2,000 shares worth $200,000. After, Cherry still has 2,000 shares. And again, remember the corporation is a separate legal entity. So when you're looking at the shares, does Cherry have any significant change in what Cherry has other than not looking at value but just looking at those shares? And the answer is no. There's no realization. So you can sever if there's an event. What do I mean? You could sever the $300,000 value by separating out the $200,000 you initially had and then $100,000 that have gone above and beyond. If Cherry, for example, was to sell 2,000 shares to somebody for $300,000, you could separate the $200,000 that Cherry initially contributed to $100,000 that Cherry now has after the first year of operations. That would be severable. But is there any event that allows that, like an exchange or some type of severance, again, some type of separation event where you can actually separate those things? Or even if the corporation distributed out that $100,000. Well, there is no distribution. So the realization is no. So therefore, there is no gross income because we do not have realization. And by the way, there would be dominion control here because Cherry does have the stock, the 2,000 shares, but Cherry can do what he or she's what she sees fit because there's no restrictions on keeping the stock or whatnot. So there's no gross income because of the realization. So again, the key is there must be this event where you can actually separate out what there was initially, the 2,000 shares, the $200,000 from the remaining $100,000. And it's not. Cherry has before 2,000 shares, after 2,000 shares. It's not until Cherry actually has an event that amount can be separated out. So I hope that helps you understand realization more, and that shows why Cherry does not have gross income.